Hey guys, this is Bruce Marshall from Simpler Trading, and today we are going to talk about hedging your portfolio. So I get this question all the time. Do I hedge now? When do I hedge? How do I hedge? What vehicle do I use to hedge? Do I need to hedge? And we're going to jump in and dive into all this, and got a lot of really good points here. Got some very specific levels I want you guys to watch and pay attention to. So let's jump right in. We'll start with the S&P 500. This is a one-year chart of the S&P 500 index. Now, historically, the market will correct about every 1.5 years, about 10%. So about 10% every year and a half, 20% about every 5.5 years or so, just on average, going back, historically. So on 7,000, 10%, that's a 700 point drop. That gets us down here to about 6,300, generally speaking. Now this over here was the tariff sell-off 2025, when Liberation Day happened and the tariffs went into effect and all that kind of stuff, or were announced, I suppose. We went down over 20% at that point. So these sell-offs are becoming, I think, more frequent, honestly. So I've been trading professionally for over 35 years, managing money, funds, all that fun stuff. Um, they're coming more frequently, in my opinion. So let's take a look at this. First of all, I do want to mention. So I'm looking at the S&P 500, and why do we want to do that? If you're hedging, I think the S&P is probably the easiest way to hedge an overall a broad-based portfolio. Now, I typically people that are hedging typically are more concerned, obviously more concerned about protecting principal and all that. I work with people that are professional, retired, getting ready to retire, that type thing. We have to protect the assets. We're all getting older, right? So it's very important that we at least know how and have different, have a variety of ways to hedge. Some are less expensive, some are more expensive, some are more powerful, I suppose. Maybe that's the right word. So that's what we're going to talk about. And there's so much to talk about here. I've actually chopped this up into 4 different mini sections. So I have a little mini series going here, and I'll keep these short. But anyway, let's jump back here and look and see this right. So right now, again, one-year chart S&P 500. We can always look at the 200-day moving average here. That is typically, historically, is a good level of support, right? So that would get us down to about 6,600, 6,650 or so, kind of something like that. Now that might be kind of the first stop in some hedging light, I would call it, LITE, light. Something to do just kind of on a regular basis. Now I don't hedge all the time. It's expensive to hedge. It can get really expensive, but you can do hedging light and work around, sell some premium, kind of pay for that stuff. It's actually not that complicated to do. I'm going to talk about that in some future videos, but let's jump in here and look. I want to look at the longer term, and I want to show you why we need to hedge. Okay, so this, if we look back, now this is, I can't even fit it. This is back the max chart. We'll go back to 1993, and here's where we are now. You can see obviously what a crazy run this has been. Again, I've been trading professionally since 1988, actually. But we're at 7,000 here. Very, very steep, moves here. A lot of this is due to QE and all that kind of stuff. That's the housing crisis. So we could come back a significant amount in the right scenario. But what I want to show you again, why should you worry about hedging? Let me make this a little bit bigger here. If you notice this, so the .com, if you guys are old enough to remember this or were around trading or whatever, there was a 50% drop. It took 7 years to recover. So from the top here, that's 1999, 2000, 2001, 2, 3, 4, 5, 6. So right there, it took 7 years to get back to the original, got your money back kind of point there on the SP 500. Then we get hit with the housing crisis, 57% drop right there, right? 5 years to recover. 1, 2, 3, 4, 5, all the way over here before you're back to even, right? So it's 7 years there, 5 years there. If you're like me, you don't have 5 or 7 years just to kind of wait to get your money back. So that's why the importance, obviously, why we need to consider hedging and why we want to protect our portfolios, right? It is, it's been very good, very easy. I should never say easy, but it's been very good trading and good investing in the last, say, 5, 10 years, obviously with the market. So, but again, we have to protect that stuff. So let's zoom in here. I want to do let's do a 10-year weekly. I want to show you some levels. This is pretty cool. Pay attention here. So this is the start of COVID, 2020 COVID, and it is crazy that COVID, as bad as it was, is a tiny blip on the radar compared to some of these other things we've had, right? So if we do a simple retracement here, I'm going to go to the low of the COVID low there and go to the high point there when we rebounded. And if you notice, you see that 50%, we pull back 50% of that rally up, 50% back down. That's very, 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 very typical Fibonacci retracement, right? If I click on the low, now I'm not cherry picking these numbers. I'm going to go directly off that same low, and I'm going to go to the next high up here. Look at that, 50% retracement. I mean, to the tick, right? 50% low to high to there, 50%, same low. Again, not cherry picking these numbers, low to high, and we could use that. It's going to be the same thing. Right to there. Let's go to this number and see where we get to the high that we're at right now. So this gets us to about 6,000. 59.18 to be exact. We're rounding here, right? So 50% retracement could get us all the way back down there. Now we did a ballpark math. If you said 7,000 times 10% correction, 7,000 minus 700 gets us to 6,300. So this is kind of the zone that's potential, right? Now realize also that this 50% back down to here, this might not be the high. Maybe we go to 7,100 and the 50% is up here, but it's substantial. It's a substantial distance to pull back. So anyway, I'm trying to get you thinking what's possible. Now that we know what's possible, again, this is kind of bigger picture, I would say, and this is not black swan stuff. If we had some real black swan stuff, now you might come back to the 200 again like you did here, and now you're getting kind of closer to 5,000. But as we have seen, if we zoom back out, this thing has been a very, 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 very sharp, steep climb. So who knows how much we could pull back. Obviously we have to have a catalyst, something really to kind of get us started. I don't see that honestly right here yet, or in the future, but we've got potentially more rate cuts coming, all that kind of stuff. So we're really kind of in limbo. So let me take this off. We're going to go back over here real quick. I'm going to remove that, and we'll go back to the 1-year chart again. The kind of hedging light stuff. I mean, I've been saying this all the way back here. So we've been in this chop mode for a while, right? This is the start of 2026. This is November. This is December of last year. We kind of started this chop over here in November, and we're just tight range bound. And you can see the kind of the curvature looks like it just wants to roll over. Just eyeballing. But we're going to blast off here, or we're going to come down. Now the healthiest thing that could happen would be the market to pull back, obviously, and that we are starting to get some pretty good valuations on some of the names that got extended. Everything got extended, right? But again, that is why we want to consider some hedging. Now, one last thing here, I'm looking again at the SPX. So in the upcoming videos, we're going to use SPX. Now SPX is the main way to hedge, right? SPY is the little brother. I suppose it's 1/10 the size of SPX. So if this is 1,000, this is 100, that kind of thing, right? Or actually 10, sorry. The other thing is that, oh no, 100 is right. So XSP is the other one that we use. These are very liquid. The XSP, we're going into this more detail. and SPX are European style expiration, which means they can't be assigned early. The SPY can. That can be important when you're hedging or when you're holding a trade that, for example, for a hedge, you want to hold it to the end of the trade, right? You're subject to early assignment there potentially. Not a huge deal, but something to be aware of. So that is the three instruments that we're going to use. And in the next video, I'm going to talk about an SPY. We track some institutional trades, hundreds of thousands of contracts. We locate them. I show you how to do that. We find them, big trade, and we kind of piggyback on that. And that's more of a black swan kind of deal. And if we're going to do that, we're probably going to go out a little bit further in time to do it, give it time to work and all that kind of stuff, to maybe target levels, that kind of thing. Then we're going to talk about SPX, kind of some hedging like back to here. And then we're going to talk about other variations with XSP. So those are in the upcoming videos. So be sure and check those out. And let me know in the comments if you have any questions. If I forgot to cover anything, I'm glad to do another video or whatever. Just let me know. Obviously, like and subscribe and all that stuff. But if you want to trade alongside me day by day, I have a trade service called Bias, and I'll put a link down below. We do this stuff all the time. We do all kinds of trading, conservative income, option income trading, right? So anyway, let me know if I can help. That's what I'm here for. Leave a comment or check in the links down below. So thanks for the time, guys. Check out the next video. We'll get into the institutional trailing on the institutional trades there in SPY. So thanks for the time, guys. I appreciate it. Take care.